Good evening, everyone. Am I audible?
Yes.
Yes. Thank you, Manish. So, I believe we are ready to begin our today's industry expert session. So, a warm welcome to all of you joining on today's session. I believe today's session will be insightful and helpful for all of us here. And I would also like to welcome our esteemed speaker today, Ms. Shruti Pathak, who is an analyst at Innova Consulting. And she's here today to share her experience and insights on the topic from scorecards to ECL, a statistical approach in risk modeling in banks. A brief intro about our esteemed speaker today. Ms. Pathak holds a bachelor's degree in statistics from the University of Mumbai and a master's degree in statistics and data science from NMIMS University. She began her journey with a data science internship at Atomic Asher LLP and later joined Auronova Consulting, where she now works on credit risk modeling projects. Ms. Pathak is also passionate about applying machine learning to solve real world problems and continues to explore new areas through personal projects and reading. And before we begin our session, I would like to add a few quick reminders. Please keep your microphones turned off to ensure that the session goes uninterrupted and smoothly. And also, please keep your cameras turned on to create a more engaging atmosphere. And without any further delay, I would like to hand over the virtual stage to our esteemed speaker today. Over to you, Ms. Pathak.
Thank you, Shashwati, for such a great introduction. I'll quickly share my screen.
Sure.
Is it visible?
Yes, ma'am, it is visible.
Yes. Hello, everyone. Today we're talking about risk management in banks, and we'll cover several topics from creating scorecards to ECL, which is the expected credit loss, which is modeled in banks on a regular basis. I will not dive much into the modeling part or the nitty-gritties of it. I will give you a basic idea of how it works, what all things we do, and then if anyone is interested, you can contact me and we can discuss it privately. Yeah. So, to understand risk management in bank, we need to understand what exactly banks do. So, the primary the working model of the banks is that they collect money from debtors, and then this money that they have collected, they then give out to people who need loans, people who need housing loans or personal loans for businesses, etc. So this money pool that they have collected from debtors is then lent to these people who need loans. In return for the money that the depositors are giving them, they get certain kind of interest. For example, if you are depositing your money to a bank, you get some 7% interest per annum. And when you take a loan from bank, they charge you around 10%, 11% interest for every year. So whatever this difference is there from 7% to 11%, that is how banks earn money. That is basically how that is the revenue model of banks. So initially, when banks started, they were on a smaller scale. So it was easier to understand whom to give the loans, how much interest you want to charge on these loans. So and then this was also a very trust-based sort of lending model that you know this person, you are in the same village, you know what this person does, how much is this income of this person. So it was easy to give loans. But then, as banks have grown bigger, as data is accumulating with banks, and as there is standardization of the process of giving loans to people, we need a more generalized way of deciding the terms on which you want to give loans to different people who need loans. For example, you want to decide what should be the what should be the amount that is lent to the person, what should be the duration of the loan. You would also want to decide how much interest you want to charge to a particular person. So, for example, if someone is asking for a home loan and a vehicle loan, you would want to give different duration and different interest also for that. So that is how the evolution of banking has gone over the years. And then when you are talking about banks and then you are giving money to someone, there is a certain risk involved. What if this particular person is not able to give me back? Or what if this person actually came to me with the intention of doing fraud and has no intentions of giving back the money? So in this case, you want to have a certain number. You want to know how much risk is involved in this particular transaction that you are undertaking. So this brings us to risk management, where you want to know if you can give money to a person and how much of the money you expect back from the person. So this brings us to risk management. The three kinds of risk that we consider in risk management are credit risk, market risk, and operational risk. Credit risk is basically the risk that a person whom you have given the loan is not able to pay back the loan on the terms that you had agreed upon initially. So, for example, I am giving Mr. X a loan of say 10 lakh rupees, and I have decided on an interest of say 11% per annum for say 7 years. And then this person took loan for say business purposes. And now Mr. X, for the first 2, 3 years, the business went very well. And then later on, there were some issues with the business, and this person is not able to pay me back. So that is the risk that I am encountering when I say credit risk. The next kind of risk that we generally see is market risk. So, along with collecting money from depositors, banks also have money from investors, from stakeholders. And what banks generally do is this money is then invested into the market, say in government funds, in equity shares, in the stock market, because banks wants to diversify their portfolio. So now the risk that is involved in this market, for example, the market crashes or something else happens. This is what market risk encounters. So, for example, if I have a bank and I have invested some money in a government bond, which was supposed to give me fixed return of 6%. But now, after some years, the government decides that we are giving 8% on this particular a new bond we have released, and we are giving 8% interest on this particular bond. So now the bond that I had initially, which had 6% rate of interest, no one would be interested in that bond, and now I am losing money in that bond. This kind of risk is considered under market risk. And the next kind of risk is operational risk, which is very different from credit risk and market risk. So in credit risk and market risk, actual money is considered. There is actual loss of money that we are considering in both sections. But in operational risk, what we are considering is the risk that is involved due to the internal operations of a bank. Say, for example, there has been a data breach in the bank, or for example, someone hacked into our servers, and now we have lost our data, or something like that. Someone came to us and committed a fraud. That could happen. So, all of these things come under operational risk. And there are different ways of mitigating each kind of risk. For credit risk, market risk, and operational risk, there are different models that are considered. For this particular presentation, we will talk a lot about credit risk, and anyone who wants to explore market risk and operational risk is free to do so. I will just tell you what is considered under market risk. Generally, WAR models are considered, or stress testing is considered when you are doing market risk. For credit risk, we consider scorecards and everything that we will talk about in this session. So, when we're talking about credit risk, and to just reiterate, it is the risk that a person that I have lent money to is not able to pay back that money on the terms that we had agreed upon in the beginning of the loan. For example, if I'm giving a loan to a person and I'm giving it for a certain duration, uh, for a certain time period, and on certain rate of interest, and this person is not able to return that money back to me. So in order to capture this risk, we consider five kinds of models. The first model that we consider is an application scorecard. So, for example, I am going to a bank and I want to apply for a credit card. This bank will consider my details and then find and then build an application scorecard for me, and then decide if the bank should lend money to me or not, if they should give a credit card to me or not. It may have happened with everyone that you are applying to a credit card and then it is getting declined or it is getting rejected for any reason. That is what the application scorecard does. So for example, if I am going to a bank and saying I want a credit card, they will consider different characteristics. Like for example, what is my age? What is my occupation? Am I doing a service or am I having a business? What is my income like? Are there any other loans that I already have? And then on basis of these particular characteristics, an application scorecard is built. And then on the basis of application scorecard, they decide what should be the credit limit that they want to give you. And if they at all want to give you the credit card or not, all of that is considered under application scorecard. Then comes the behavioral scorecard. So this is done for customers who are already there with the bank and who are already customers of the bank. They want to monitor the behavior of this particular customer, depending on which they can decide um, if they should redefine the terms of the agreement that they had made in the beginning of the loan. So, for example, so behavioral characteristics like as the income of the person increased, is the person paying on time? How much portion of the loan is the person using? For example, if you are considering a credit card and a bank is giving you a credit card, it will consider, okay, has this person started earning more? Or is the person using all of its credit limit? What percentage of credit limit is being used? Has the person ever missed a payment? Is the person very particular about the payments? All of these characteristics are considered under behavioral scorecard. And also under behavior scorecard, what I try to do is if suppose I am a customer from a bank and I have a credit card, they will try to push loans like get a housing loan from us, get a personal loan from us, or they will try to give you better advantages based on the basis of your behavior with the bank. So that is where the behavioral scorecards come in. It is used in cross-selling of products. If you have a home loan, they will try to give you a car loan or an education loan, something like that. Now, this is also used to know if the risk for a particular person is increasing or decreasing and the overall behavior of the person with the bank. So now, for example, it so happens that despite all the modeling that we have done and despite all the care we have taken, it is possible that someone, a particular customer, will default for any reason. You cannot make models that give you 100% guarantee that this person will default or not default. So if it so happens that a particular customer really does default, then you want to know how much of the loan how much the amount can I get back. For example, if someone had a mortgage loan and this person had kept some collateral, some property, you want to know how much of the loan is left and how much of that is are you able to recover from the collateral. That is where collection scorecards come in. So, for example, I have a loan from a certain bank and I have paid a certain amount. Say they had given me a loan of 10 lakh rupees and I have paid about 7 lakhs of rupees and 3 lakhs of rupees is left. So, and at that point, for some reason, I am defaulting on the loan. Then the bank will consider various factors like what kind of repayment I have made in the previous period. If I am even something as small as am I picking up their calls? Am I responding to their messages? Or if I promised to pay a certain amount by certain date, and if I'm not able to pay that amount, so all of these factors are considered. They make different variables for each factor, and they make a collection scorecard out of it. This is used to decide or to estimate sort of what amount will I be able to recover from the collateral or from the person. It also gives you an idea if you will be able to recover any amount, or you would just have to write off that particular account and assume that that particular you might not get the money back. So this is for each customer, right? We are considering one particular customer at a time. When we are considering a loan, there are two factors that could make a person default on a loan. It could be the customer behavior itself, and it could also be the economic conditions of the environment that they are living in. For example, if I am taking a loan from a bank, it also matters about my own personal conditions at that point, and it also matters about what are the conditions of the country at that time. That is where point in time PD comes in. This is where we try to capture the macroeconomic factors that are affecting the delinquency behavior or the default behavior of a customer. So, say if I am a businessman and I am doing import-export business, and just like what is happening right now, some country has imposed tariffs on my country. Then now I am not able to do my business anymore. It is not as smooth, and then I am facing a few hiccups. That is where those kind of things is what these macroeconomic factors try to capture. That is what is used in point in time period. So, say you are considering the GDP of a country, the unemployment rate of a country. If the country is heavily dependent on oil factors like countries in the UAE, etc., then you would consider oil prices in that country. If the country is heavily dependent on housing, so then you would consider the housing prices of that country. And then after considering all of these factors, you make a point in time period, which is the probability of default. And it is made for one particular section. For example, say housing loan, or say personal loan, or say business loans, but then business loans in a particular sector. And then such kind of probability of default is created in every sector. That is what is captured in point in time. And now, um, just like I said, if you are giving loans, it is very, very much possible that someone or the other is going to default on that particular loan. So even after you have considered the scorecard, you have modeled the scorecard, you have given the loans to the best customers who you think will repay all the loans. And you have also considered the macroeconomic factors in your country. And you have estimated the probability of default. Even after doing all of this, there is going to be a chance that someone does actually default on your loan. And then, if someone has defaulted on your loan, you want to know what is the loss given that default has occurred already. So, for example, if I have given a loan of say 10 lakh rupees and 3 lakh has been paid and 7 lakh is the outstanding amount. But then there is certain collateral to that particular account. So, you want to know after even after selling the collateral, what what amount of loss are you going to face? That is captured in loss given default models. It essentially captures how much money will the bank lose in case that a default has already occurred. So that is the loss given default models. And then finally, after doing all of these modeling, what a bank finally wants to know is what is their expected credit loss. So for a bank, when you are giving loans, you are doing every kind of analysis and you are giving loans to a particular person. You want to know how much money should I keep in my bank such that I don't go bankrupt. So, if you are giving, so it should not happen that you are giving a lot of loans and you don't have enough in your bank that if a crisis occurs and everyone is defaulting on their loans, then you don't have liquidity in your banks. So, that is where the ECL modeling comes in, which is basically captured using PD and LGD and EAD, where PD is the probability of default that we create using the scorecards and the quantum time PD. LGD is the loss given default that we saw, and EAD is the exposure at default. So, for example, uh, if a person defaults at a certain stage, what is the exposure? What is the outstanding amount of the loan that is left once a default has already occurred? Using this ECL, using the expected credit loss, the banks decide how much provisions should it keep in its treasury so that it is able to cover all the losses that it might encounter in the further year. So, expected credit loss is generally done for 1 year, and you keep provisions for 1 year so that even if a lot of people, if a crisis happens and a lot of people are actually defaulting on your loan, you have still kept provisions in your treasury so that the bank does not go bankrupt. That is what we are trying to capture in expected credit loss. That is the whole journey from scorecards to ECL. And that was all I wanted to say for today. And if there are any doubts, we can further discuss it.
So can you take some data and explain this all these things which you have shared in this particular slide, like behavioral scorecard, collection scorecard?
Data I cannot show you. I can talk about it.
No, you
So,
don't
for
need to
example,
show the data. You can create some dummy data and you can show some calculations for us. You need not take the exact data from your company.
okay. What kind of calculations do you want to look at? And what kind of scorecard do you want to look at?
You have showed this formula, right? ECL with some expected credit loss formula is there, right? Yeah.
Mm-hmm.
So for this, like you can put in some numbers and show like
Okay,
how
all
it
right.
actually happens. Yeah.
Yeah, yeah. So for example, say that I am a person and I am going to a particular bank and I am applying for a loan. And say I am applying for a loan of 10 lakh rupees. And so since I am applying for a loan, they will consider my demographics, like what is my income, what is my occupation, what is my behavior in terms of do I have other loans on me, what is my CIBIL score, things like that they will consider, and then they will create a scorecard. And on basis of that scorecard, they will give me a loan. And say on this 10 lakh rupees loan, so we are saying that the principal that we have is 10 lakh rupees. And the interest that the banks decide is 11% rate of interest for the duration of say some 10 years. Once this has been decided, then to go to ECL. So ECL is done for a particular bank in general. And then for ECL, you will consider the delinquency behavior of customers, and along with it, you consider the point in time PD, which is the macroeconomic factors in the entire country. And then on basis of this, you make different models. So for PD, you make different models. Under PD, you have behavioral scorecard and your PITP. So under the PD factor, what you do is for each account that you have, for each loan that you have given, you create a probability of default in for that particular account. And then on basis of the probability, so for example, you have an account A and you say A, B. You have these four accounts, and for each account, you have estimated that your probability of default is say 10% or say 5%. Someone has 0.2, someone has 0.15, something like that. And this is your behavioral speed, right? Behavioral probability. And once you have done that, you will then consider the macroeconomic factors in the country overall. And a different model is created for the macroeconomic factor. And then on the basis of that PIT-PD that you have, which is the point in time PD, which is the macroeconomic factors, you will then give a certain point, a certain scalar is attached to that particular PD, and that much is given for each account. So say your point in time PD that you have estimated for the housing loan portfolio is around 20%. And so depending on each account behavior, you are giving a particular scalar and you multiply it with the point. So say you are multiplying it, so you're doing point 1 into point 2. Then you are doing 0.15 into point 2. Then something like that you are doing. And now you have these two PDs. You have the behavioral probability of default, you have the PIP. And then on the basis of this, you would then, so depending on different banks, each bank has a different model. Some banks follow an additive model, some banks follow a multiplicative model. Wherein in the additive model, they will just add the two PDs, the behavioral PD and the probability, PIT PD. And they will give you a final PD estimate. Some banks use a multiplicative model. Some banks don't consider the economic factors at all. They just consider the behavioral factors. Some banks don't consider the behavioral factor. They only consider the macroeconomic factor. So if suppose my bank is using a additive kind of structure, then say you have mm, so this is what the bank has estimated, and then you finally do a PD, which is going to be your this plus this, which is one. And then addition of all of this. And that is going to be your PD factor. Then when you consider the loss given default, that is an entire model which is built, which is using data, and then you are assuming that the loss has already occurred. So you, from all of the data you have, you will subset the data where loss has already occurred, and then you find out where default has already occurred. So the person is not able to pay or is not willing to pay back the money. And then once the default has occurred, you try to estimate what is the loss for that particular account. And then similarly, you find the loss given default for each of the accounts, and then you know the exposure at default. So if that particular person has defaulted at when the outstanding amount is say 33 lakhs or say 30,000 or say 30 lakhs, then that is your exposure at default. That is the outstanding amount at the point of default. Then the ECL. So then wait. Uh, then you would have the LGD, which is the loss given default estimate, and then you would have the EAD. And then you would have an ECL for each account. And then you would have the summation of all of this ECL that you will get, sum of all of these factors. And that is going to be your estimate for the expected credit loss. And then on basis of that, you would do provisions for that you want to keep in our treasury so that you don't go bankrupt. I hope that solves your question.
Yeah. But we
Ma'am,
would have liked that if you have brought in some data set and showed this, you would have liked that. It's okay.
Okay.
So, thanks, Ruby, for the session. I have a doubt about availability of data for all these computations, because any model, the success depends on availability of good amount of data. Now, you look at a bank which is in existence for say less than 5 years or 10 years. It has to have a history of lending, then defaults, then some losses, litigations, everything. If it has to pull some data relating to your LGD or probability of default or exposure at default values.
Yeah.
A bank which is in existence for ages, like say, for example, State Bank of India in India, they have, a history that it is there since independence or even before that. And then, so
Yes,
they
right.
have a huge database. Whereas a bank which is getting established recently or in last 5 years, they may not have the kind of data needed to support. Now, my doubt is whether there exists a central database managed by RBI or some central agencies from which individuals bank can pull the required details and build their own models, or there is always some kind of reservations about sharing data by banks and all, or every bank just uses what is available in their database alone. Because if you look at the model like CIBIL and all, see a person's credit history cannot be built by CIBIL on its own. It is pulling data from different places. So different banks or different transactions, etc. So is there something like that in existence for a bank to build its ECL model as you shown, or
Yeah.
they use their
So yeah,
just
right. Yeah, so yeah, you are thinking on the right path. So what generally happens is if you have a bank which is a small bank and not in existence for a long time, there are generally guidelines issued by the RBI also, and there is a Basel committee, which is an international committee for banking regulations. So if suppose you do not have enough data, they will have some thresholds, some values that you can use for the time being till you get enough data to keep your provisions accordingly. So it is, and also you could also do that. You can borrow data from other banks, or whatever the data you have, small amounts of data, you could use that to build an account. Or I think the best practices that is you stick by the threshold that is given by RBI or the Basel committee, and you make your provisions on the basis of that.
so that's one approach. But there are two issues here. One is, for example, a probability of default,
Mhm.
which I need for my decision to lend. Other thing, what you are focusing on is, from a regulatory perspective, how much provision you should have, all kind of things.
Mhm.
But for me to compute, or to put another term, if I want to do my pricing of the loan based on
Yeah.
my risk adjusted pricing, or
Mhm.
based on the risk. So if the probability of default is more, I may charge more. So a guidelines
Yes.
from a central bank or a regulatory
Mhm.
authority is mostly from a regulatory perspective, how much
Yes.
provision you should provide in your balance sheet or whatever is there. Whereas for my operational convenience, I need data. Otherwise, I cannot price my borrower accordingly. When a customer walks into my door, I don't know what is
Mhm.
his probability of default, because I don't have a previous data with me if I am a
Right.
relatively new bank. So why I'm asking this is just to understand how a
Yes. Yes. Yes.
new or relatively new bank handle this situation, because banks are getting established. So handles this, or how it addresses this challenge of really using the
Mhm.
modern technological advancements and modeling facilities in the absence of data. So that is what I'm not coming from a regulatory perspective, because in
Yes.
under
Yes.
regulations there are what you call standardized approach, and where none of this is considered, but just some blanket provision is given, and you provide some what you call some kind of provision, capital provision. So I'm coming from more from an operational perspective of these banks. How really a relatively new bank, old banks data is not a problem, handles this, or
Mhm.
how it is able to use all these technological advancements when they employ people like you. If there is they cannot provide the necessary data, it's of no use, right? So that is what my
Right.
question originates.
So in banking, so one thing in banking is that you don't really use machine learning models to do these kind of modeling. You use basic models like logistic regression is something that is used a lot in banking, and you cannot use machine learning models because there is the issue of explainability. So when you are talking to say auditors, or you are talking to regulators, they don't like the black box. They like a basic equation that can be explained or that can be understood very easily. So you generally use logistic regression. And then for logistic regression, you don't need a lot of data like in machine learning models. A small amount of data is enough to give you good estimates, not very good, but okayish estimates they can give you. And so when we are talking about behavior scorecard, that is for customers who are already existing with your bank. So their data is not a problem. Customers are already there with your bank, their data is there with your bank, and you use that particular data to make your behavioral scorecard. For application scorecard, you use data. So data like what is the age or what is the income. So preliminary basic data is used, and on basis of that, a score is provided to everyone. So they don't use. So every time a customer walks in, they take their basic information, and on basis of that, they create that particular scorecard. So I hope that answers your question.
Mm, Yes. So what you are telling is all these advanced models, whatever, or the facilities or features available with all these technology advancements are not used to a great extent in banks. That is what you are telling.
No. Yeah, yeah. In banks, they stick to very basic models, which so in very extreme conditions, they use maybe random forest or gradient descent. Uh, random forest or gradient boost algorithms, but they don't really prefer very nice machine learning models.
Okay.
Even when you are imputing data, if you consider mice or something like that, if you consider say clustering or something, they don't really like those kind of algorithms. They like algorithms which are very explainable. But again, if you go to the marketing side where big banks are trying to target customers, in that case, they would use a lot of algorithms. So if you are considering models which do not come under regulatory compliance, in that case, they will consider all kinds of models. Then they will use deep learning, machine learning. For their business side, they will use all of that.
Just to reiterate, if I understood it correctly, for
Hmm.
pricing purpose or some other purpose, they may use machine learning or other algorithms. But where it
For
involves
pricing, no.
a regulatory reporting, how if you have to tell the regulator what percentage, how the provisioning is made, they don't use
Yeah.
this. Okay,
Hmm.
thank you.
Yes. So even for pricing, when you are deciding the rate of interest, the terms of the agreement, they don't use machine learning models. When you want to target customers, say you have HDFC Bank and it wants to know if this particular customer base is interested in a home loan or something, where you want to do marketing strategies, etc. At that case, machine learning models are used. But under provisioning for ECL calculation, probability of default, they do not use machine learning. Please.
Okay, thank you.
So, a very insightful session had been taking place today. Thank you, ma'am, for the insightful session. And one of our students have also posted one question in the chat. So, Shreyas asks that, will you please elaborate over civil reports and the authority that regulates it?
About civil reports, I will have to check it a little. So, what I know about civil reports is it uses data from all banks. It pulls all of that data, be it data from housing loan, be it data from personal loan, be it data from a car loan, and then all of this data is pulled together, and then a certain score is given to all of the customers. So, this is a very generic score that you can give about these. Behavioral behaviors of a customer. So that is generated by the civil itself. The civil is an authority, and when so one natural question you would ask is what is the requirement of a different behavioral scorecard when I already have the civil report. So it is like the civil report is a very generic estimation of the behavior of person. But when a bank is giving a housing loan to a person with a certain income who has other three loans already, then in that case you want a very a scorecard that you have created basis on the basis of your own data. That is where all of this modeling comes into the picture.
Okay. I hope, Shreyas, your question was answered. And, ma'am, additionally, I do I'm on wondering about some questions. For example,
Yeah.
um, how are exactly credit scorecards developed or validated statistically in the banking risk models?
Okay, so for each model, there is a different way of. So, when you talk about model development in banks, there are two main teams that are created. One is the model development team, and one is the model validation team. So when you develop a scorecard, that comes under development team, and you use normal evaluation metrics, like say you use the MAPE, or you use the R square of a model, or you use the RMSE of a model. There are also metrics like the population stability index, where you want to see if the population is stable throughout the period that you are using. And there are different metrics that are considered while building these scorecards. Some are generic that we have learned in our normal BS level also, and some are very specific to the banking sector that are used for this uh, development as well as validation.
Okay, okay. Thank you. And I will definitely look more into the topics that we have discussed today. One of our other participants is also asking, will you please elaborate on existing customer management or unsecured lending strategies, like not the regulatory part? What is the actual job there? What kind of models do we use?
Let me just look at the question.
Sure.
Like, so, when you talk about unsecured lending strategies, I think you are talking about strategies like buy now, pay later, or different kinds of uh, so small companies which are willing to give loans and something like that. So this is so actually all of these companies also, which are called NBFCs, which are non-banking financial institutions, all of these are also there under regulatory guidelines, and they also follow some regulations. And then they also have similar kind of modeling used for their uh, provisioning. So it is also considered under regulation. It is not spared like that.
All right. I hope that asks and that answers our participants' question. So, students and participants, if you have any more questions, please feel free to either unmute yourself or post it in the chat box. The floor is open for discussion now.
Yeah, the agenda of this meeting also says that you will be providing some insights on how to enter into this banking domain using data science, like for a career perspective. Would you be doing that today?
Okay, so if you want to enter the banking sector from a career perspective, I think you should be very you should be able to clean your data well. That is something that so you don't really get very clean data from your clients. You sometimes have very unclean kind of data. So you will have to clean your data well. You will have to impute the data. So you need to have different strategies for doing that. And you need to know how the algorithms work and everything. But overall, when you're trying to enter the banking sector, it is not very difficult per se for a data scientist. Assuming you have learned everything, so linear regression, what are the assumptions of linear regression? Why are they in place? Logistic regression, what are their assumptions, etc., etc. You should know how the basics of random forest, say, or gradient boost algorithms, extreme gradient boost algorithm, what happens behind it. So if you know basics of statistics, say you want to, they want to know what is the significance of p value, for example. What are the different statistics that are used? What is the t statistic, etc. And once you know the basics of statistics and a little bit of machine learning, entering into the banking area for risk modeling in specific is kind of sort of easy. In sources of income, yes. So the way I had said, other sources of income is when they try to when um, they invest in, say, government bonds, they invest in equity shares, they invest in the market. That is one form of revenue from where that is one source of income for them. And along with that, you have investors who pool in money. You have stakeholders who pool in money. So that is where the money comes into the banks. They also charge certain fees, some payment fees, some fees for whatever facilities they are giving. You pay ATM fee or something like that. So that is also considered. But majorly it is from the interest that you pay and the market investments that the banks make.
Okay, I hope that answers Khalid's question. Ma'am, also on another note, since there are a lot of students here who will be joining the workforce very soon, so is there any
Yeah.
personal projects that you would like to suggest, which could be helpful for our students if they want to go into fintech?
Yes, so there are a lot of projects. Like there is one scorecard building project that almost it is there on Kaggle, etc. Scorecard building. You could do customer churn prediction. You could do, yeah, primarily these two, credit scores, etc. you can do. And I think that will give you a fair idea of how it works. And other than that, I don't think there are a lot of data available for this also. And not a lot of projects are undertaken in this case, just your credit scores and what else did I say? The other one. Yeah,
Customer
I'm sorry,
churn.
I forgot.
Customer churn.
Yeah, yeah. Customer churn prediction. That is something you can.
Okay. And what tips would you have for our students who are yet to enter the workforce, if they are interested in the same field?
Mm, I think most banks or most firms that will hire you will teach you a lot about this. So you don't, apart from the basic statistics and machine learning things that is expected out of you as a data scientist. Now I am saying this from the perspective that you are going to a bank from a data scientist point of view. If you are coming from a finance background, they would want you to know certain financial keys also. So, basic terms like what is inflation, what are different indexes, how does GDP affect something, how does, for example, customer price index affect something. So they would expect you to know some finance terms also, but that is a plus point if you are coming from a data science perspective. From the data science perspective, you can go in thinking of your basic statistics. You should know it very well, and your machine learning you should know very well.
Okay. I really hope that these tips and all the other answers that you have addressed to the issues and the questions that our students have raised have been helpful to all of them. Personally, it has been a lot of insight for me as well. So thanks a lot, and thanks a lot to our students as well for coming in and promptly being so active in the discussion forum and here as well.
Yes.
So thanks all. I hope that you all have a great weekend ahead, and we will be concluding our sessions here. Thank you, ma'am. Thank you to
If
all the
anyone has
participants.
any doubts or discussions, if you want to have a discussion, you can DM me on LinkedIn and we can have in-depth discussion about anything.
Sure. Thank
The
you, ma'am.
LinkedIn is given in the mail invitation itself.
Yes, yes, we have shared your LinkedIn as well. Subrat,
Thank you so much.
if you have received our invitation mail, you should be receiving our guest speaker's LinkedIn profile there itself. Yes. Thank you, ma'am. Thank you all for joining today's session. Yes, I'm hoping that everyone enjoyed listening to you and the topics that you shared. Thanks a lot.